Good morning. This is Patricia Croat of Nothing, welcoming you to ING's second quarter 2021 conference call. Before handing this conference call over to Steven van Rijswijk, Chief Executive Officer of ING Group, let me first say that today's comments may include forward-looking statements, such as statements regarding future developments in our business, expectations for our future financial performance, and any statement not involving an historical fact. Actual results may differ materially from those projected in any forward-looking statement. A discussion of factors that may cause actual results to differ from those in any forward-looking statement is contained in our public filings, including our most recent annual report on Form 20-F filed with the United States Securities and Exchange Commission, and our earnings press release as posted on our website today. Furthermore, nothing in today's comments constitutes an offer to sell or a solicitation of an offer to buy any securities. Good morning, Stephen. Over to you.
Good morning and welcome to the second quarter 2021 results call. I hope you're all in good health. I'm happy to take you through today's presentation, joined by our CFO Tanate Phutrakul and CRO Liliana Chortan. Thereafter, we will take your questions. The key messages. Another quarter of COVID-19 has passed and we see positive signs of vaccinations and economies reopening, however also the effects of the Delta variant with infections spiking again. Overall, we are moving back to normality, but we're not there yet. We have taken steps on climate change. The situation is not where the world needs it to be, and the pressure to transition to a low-carbon economy continues to grow. We continue by financing the transition. We have been doing that by our Terra approach and have upped our ambitions by joining the Net Zero Banking Alliance. If you look at the results under the current circumstances, I am pleased that we show such a stable financial performance. As I said last quarter, looking at the results, you wouldn't think we are in a crisis, and I'm proud of all the hard work by the colleagues, realizing another record quarter in fees, growing our mortgage book, managing the pressure on NII while keeping expenses under control. Risk costs were minus 91 million. We have released part of the buffer built up in 2020, reflecting an improvement of macroeconomic indicators. The quality of the loan book remained strong, with very limited risk costs on individual files and a lower stage 3 ratio of 1.5%. Overall for 2021, we expect risk costs to be below our through-the-cycle average of around 25 basis points. CET1 was higher at 15.7, with 50% of the second quarter resilient net profit reserved for future distribution. This brings the total amount reserved for this outside of capital to just over 4 billion, of which we distribute 3.6 billion after September. Now, before we go into this quarter's figures, let me spend some time on a few topics I want to highlight, being the contribution on green transition, our strong performance on fee income, and our distribution plan. The first topic is the transition to a low-carbon economy on slide 3. As I mentioned, when it comes to fighting climate change, the sense of urgency and the need to accelerate is clear. Extreme weather is becoming more and more frequent. Stakeholders see the need for more action and speed, and the urgency is also clear with policymakers. We fully subscribe to the sense of urgency and have been supporting our clients' transitional efforts for several years by being a pioneer with steering our Terra book or Terra approach and offering innovative sustainable products to our clients. This support has translated into a growing number of sustainability deals with an acceleration visible over the first 6 months, as we are now already close to full year 2020. This includes a growing number of green bond underwritings for which we have received recognition, as ING was named most impressive investment bank for financial institutions on social responsible investment by Global Capital magazine. And I'm happy to say that we are accelerating our efforts and have joined the Net Zero Banking Alliance. For 2 of our Terra sectors, we are already on the right pathway. For the other 7 sectors, some gaps exist, and we will determine which actions are needed to align the pathway for each sector with a net zero ambition. I believe banks play a pivotal role by financing the transition. However, I also call upon businesses to take actions and upon policymakers to set regulations that are clear on what is green and not. These regulations need to reflect that the transition takes time, and I find it key that also transitional efforts get recognized. That credit is also given to what is not yet green but is moving in the right direction. I see this as a potential weakness in how the green asset ratio is currently proposed. On the other hand, the intentions of the European Commission's revised sustainable finance strategy to incorporate certain transitional activities in a taxonomy are encouraging. Slide 4 shows the development of our fee income with an 11% CAGR over the past 2 years, even with the effects of a lockdown. Investment product fees stand out with a CAGR of 27%, reflecting growth of accounts, assets under management and trades, and this was driven by a growing appetite to invest, an appealing investment proposition, and an elevated number of trades, partly due to the market volatility under COVID-19. Especially in Germany, we benefited from our digital proposition and growth in the number of accounts. In the second quarter, the number of trades was less elevated, resulting in lower related fees. However, with the right number of accounts and assets under management, we have a strong foundation for a structurally higher level of investment fees. Another important contributor were daily banking fees, with a CAGR of 10%. Main drivers were the introduction of new fees in challenger and growth markets, and the annual increase of package fees in the Benelux. Overall, I'm pleased with the strong performance of our fee business, keeping in mind that this reflects that especially international payments are still at lower levels, with upside potential as we return to more normal circumstances. The same applies to lending fees, which reflects still subdued demand from business clients. And we see further progress for fee income on new product propositions, for increased charging of the cost of operating accounts, and for fees on daily banking packages. Overall, our track record shows we are able to deliver on our 5 to 10% growth ambition, and that ambition stays in place. Now let me move to slide 5. I trust I have your full attention for this, and you're familiar with our distribution policy. As the ECB has announced that they will lift the ban on distribution after September, I am pleased that we can now execute on the policy. And starting with a payout of 0.48 on October 12th, or 1.87 billion, reflecting the 21 interim over 21 and 27 for the remaining amount originally reserved for 2020. After September 30th, we will make an additional distribution of 1.74 billion. The exact form is to be decided. This will be in the form of cash and or a share buyback. In the latter case, it will be subject to relevant approvals. Going forward, we will over time converge to our CET1 ambition. As long as the exit from the pandemic and government support is unclear, we will remain a prudent buffer. Now let me take you through the second quarter results as of slide 7. In the second quarter, total income year on year was supported by strong fee growth. NII included 83 million TLTRO. However, pressure was visible, mainly reflecting lower liability margins. Other income was lower, as a year-ago quarter included several positive valuation adjustments as markets rebounded from the negative impact of market volatility that we saw last year in March. This was partly offset by the 72 million receivable related to the insolvency of a financial institution in the Netherlands a number of years ago. And sequentially, fee income remained at the same high level, while lower NII was primarily driven by lower TLTRO. On to NII on slide 8. In previous quarters, we addressed that we see continued pressure on NII from low interest rates, which as well as the pandemic, which affected the levers that we generally use to counter it. We want to reiterate that swap rates have improved, however they remain below the 5-year rolling average, and we invest in maturities which can range from overnight to over 10 years. And as an example, we could say that we invest 20% of our replicating portfolio every year, so improvement will only come in over time. And we, of course, will benefit from a more steepening yield curve. NII, excluding the TLTRO benefit, was lower year on year, primarily due to this continued negative interest rate environment, while deposit inflows have been substantial. Lending margins were slightly higher, however at lower average lending volumes. Year on year we also saw negative impact from FX currency translation. Compared to the previous quarter, NII excluding TLTRO was slightly lower, impacted by the aforementioned pressure on the liability margins, which was partially offset by higher average lending volumes at higher margins. Now, this higher volume might sound counterintuitive as net core lending decreased this quarter. However, this reflects that the majority of the loan growth in the first quarter came in March and was therefore not fully reflected of average customer lending for that quarter. Our net interest margin optically decreased by 10 basis points to 136. This was mainly driven by lower TLTRO benefits, representing 6 basis points, and the remaining 4 basis points were due to an increase in the average balance sheet and the liability margin pressure I mentioned earlier. Slide 9 shows net core lending, strong growth in mortgages. Demand for mortgages continued to be strong, especially in Germany, Poland and Spain. This was the primary driver of net core lending growth in retail, with some growth also visible in consumer and business lending. In wholesale banking, we saw a high level of repayments on term loans and short-term lending in financial markets, resulting in an overall decrease. And net customer deposits was 4.9 billion growth, driven by 7.3 billion of higher savings in retail and a 2.5 decrease in wholesale banking. And I've repeatedly said that negative loan growth is not structural and that we expect loan growth to return when still there, which means that there might be a delay to loan demand, but when the demand returns, with a geographical and product diversification, we are well positioned to support our customers and capture growth. Now back to fees on page 10. Year-on-year income grew by 18% with growth both in retail and wholesale. Retail fees were up 20% with an impressive 46% growth in daily banking, and this reflects the increase in payment package fees and the recovery of domestic payment transactions, while international payment transactions remained subdued. In wholesale banking, fees were 14% higher year-on-year, as we saw some growth in lending-related fees, including in trade and commodity finance, while also payment fees increased. Sequentially, retail fees were slightly lower, mainly reflecting a lower number of trades in investment products after a record high in the first quarter. Higher fees in wholesale banking primarily reflected daily banking and corporate finance activity. On slide 11, it shows the expenses, which this quarter included 39 million of incidental items, reflecting an IT impairment and some provisions related to measures we announced for retail in the Netherlands. Excluding these regulatory costs and incidentals, operating expenses were under control. Despite the effects from CLA increases, both year-on-year and quarter-on-quarter, expenses were lower. Year-on-year, we further absorbed higher IT expenses and some litigation provisions, while quarter-on-quarter we had a slightly higher VAT refund. Regulatory costs were lower quarter-on-quarter, reflecting a seasonally high first quarter. Year-on-year, the increase mainly reflected additional DGS contributions in Germany following the Green Seal insolvency, and this included a 30 million catch-up. Going forward, we expect a quarterly impact of around 10 million until the end of 2024, which could be adjusted depending on the conclusion of this insolvency. Unfortunately, we also see some unexpected costs coming in, such as VAT charges on intercompany services following a recent court ruling for one of our peers. We expect to see the impact from this building up over the coming quarters to around 125 million annually, which we will have to absorb over time. Going forward, we will continue to steer for operating expenses to go down. On the measures announced over the past quarters, it takes time to execute, but I'm, however, very positive on the execution and pleased we found new homes for our retail customers in Austria and the Czech Republic in mutually beneficial transactions. Now then to asset quality on slide 12. The risk costs were minus 91 million or minus 6 basis points of average customer lending. And this includes a 230 million management overlay, primarily in stages 1 and 2, which partly offset a 492 million release driven by updated macroeconomic indicators. And this resulted in a net impact of minus 262 million, with releases in all business lines. Aside from these releases, in Retail Benelux, risk costs mainly came from 109 million collective provision in Belgium, reflecting model updates, of which 79 million was in stage 3. And we further saw some collective provisioning for consumer lending in the Netherlands. In Retail Challenger and Growth markets, risk costs further reflected collective provisioning for consumer and business lending, mainly in Poland, Germany and Spain, and in wholesale banking. Stage 3 risk costs were low, reflecting very limited additions. Both Stage 2 and Stage 3 ratio were lower, reflecting lower outstandings in both stages. And as I said at the start, looking at the numbers, you wouldn't think that we are in a crisis, and that certainly applies to risk costs. This is not ING specific, and I believe that this reflects the support provided by governments, combined with a positive macroeconomic outlook, which could allow businesses to make a quick rebound. However, uncertainty remains, and for that we still keep in place part of the buffer built up over the past quarters, amounting to around 425 at the end of the second quarter. We do believe things are moving in the right direction, and that for 2021 our risk costs will end up below our through the cycle average, and that is a change in guidance. The next slide shows that our CET1 ratio increased to 15.7%. I'm at slide 13. The capital was higher with 400 million, which included 700 million or 50% of net profit for this quarter, and the other 50% was reserved for future distribution in line with our policy. This was partly offset by foreign exchange impact, an increased MPE backstop, but also lower benefits from the IFRS 9 transitional arrangements. Our RWAs decreased, mainly driven by market and operational risk-weighted assets. The market risk-weighted assets reflected a lower historical VaR, as a volatile quarter was no longer included in the calculations, and lower operational risk-weighted assets was due to technical model updates. The credit risk-weighted assets were up, driven by model impacts, primarily reflecting the final TRIM impact. So this is it for the TRIM. And this was partly offset by an overall improved collateral profile of the loan book. Remaining regulatory RWA inflation is very manageable at around 30 basis points. Now, as you can see on slide 14, the CET1 ratio is well ahead of the ambition. On ROE, it is below our ambition, but we already have seen an improvement versus the previous quarter to 11.2% for this quarter. With more efficiency on cost and capital, and with growth returning, we maintain our ambition and very much intend to continue to provide an attractive total return. And to reiterate, cost income remains an important input for our return on equity. We continue to work on our ambition of 50 to 52%. And as for distribution, we have currently an amount just over 4 billion euro reserved outside of CET1 capital, with an announced 48 euro cents to be paid out in October 21. To wrap it up, the highlights of the quarter. First of all, we subscribe to the sense of urgency to transition to a low carbon economy, and we contribute to that by financing that transition. We have been doing that by steering our loan book with our Terra approach, and we have upped our ambitions by joining the Net Zero Banking Alliance. Looking at our results, these are good. This quarter we managed to realize another record quarter in fees, to grow our mortgage book, and to manage the pressure on net interest income while we kept expenses under control. Risk costs, they came in at minus 91 million. We have released part of the buffer built up in 2020, reflecting an improvement of macroeconomic indicators, but still maintaining a buffer of around 425 million. The quality of the book is evident, with a lower stage 3 ratio of 1.5%, and for 2021 we expect risk costs to come in below our through the cycle average. CET1 ratio was higher at 15.7%, with 50% of the second quarter resilient net profit reserved for future distribution, bringing the total amount reserved outside of CET1 capital to just over 4 billion. And as the ECB has lifted the restrictions, as you know, on distribution after September, we will pay an amount of 1.87 billion or 48 € per share on October 12th. After September, we intend to make an additional distribution of 1.74 billion in the form of cash and or a share buyback, with the latter subject to relevant approvals. And that concludes the presentation. Now on to your questions.
Thank you, sir. We're starting the question and answer session now. If you have a question or remark, please press *1 now on your telephone. In the interest of time, we kindly ask each analyst to limit yourself to 2 questions only. *1 for your questions or remarks. Go ahead, please. Our first question is from Mr. Benjamin Goy of Deutsche Bank. Go ahead, your line is open.
Yes, hi, good morning. 2 questions, please. First, on capital return, and then secondly, on costs. In capital return, I'm just wondering, because of this conditionality subject to approval, so just wondering, is there execution risk in case you go for a share buyback as compared to a dividend? Or, something you would expect to kick off in the fourth quarter? And then secondly, on costs, I think in Q3 last year you announced that costs are going down from here. Just wondering now, with a couple of quarters actions in place, and now you mentioned some headwinds, what's the balance? Do you think it got easier and you have some comfort from the execution so far, or is there more needed to offset these new headwinds? Thank you.
Okay, I will take the cost question, and then thank you, Benjamin, and then Tanate will take the capital question. I think on cost, when you take out the specials, this is actually the first quarter it went down, the amount still being small. We have made a number of announcements of actions that we're taking, including branch reductions, a restructuring of private banking in the Netherlands, branch increases in various other countries, including Poland and Belgium. We announced last year already a curtailing of our footprint in wholesale banking in South America and Asia. We have come to an agreement with Bank 99, or actually Österreichische Post, on transferring Austria retail activities to Bank 99. We have transferred already 50% of our clients and 60% of our activities to Raiffeisen in the Czech Republic. But what you will see is that these benefits will come in over time. As soon as you announce them, it still means that you go through a period of restructuring. You have a discussion with works councils and unions. You have potential M&A discussions with buyers, as we have now seen, and then only gradually we will see the benefits come in. So yes, I mean, with that VAT decision on one of our peer banks, of course, sometimes you have some headwinds, but I remain focused and confident on the target of bringing the cost further down.
And Benjamin, on your capital question, I think first of all, you need to realize that these capital, the 1.7 billion, is reserved outside of our capital calculations today. And the second, we have very constructive discussion with the ECB with respect to our capital management discussions, and we have applied to the ECB for a share buyback. Right. So these are all, in constant dialogue with the ECB.
Understood. Thank you very much.
Next question is from Mr. Stefan Nedialkov of Citi. Go ahead, your line is open.
Yeah, hi guys. Good morning. It's Stefan from Citi. 2 questions on my side. The first one is on NII. I wanted to see and check in, given your wholesale lending growth is actually more of a decline. What is your confidence in being able to book the TLTRO 3.2 benefits, the one that runs through December 2021 in terms of loan growth? And related to that, to the NII question, what's the outlook for expanding the negative deposit charging base within existing countries where you do that, such as Belgium? Or, for example, in Germany, there were some press articles about DIBA potentially starting to charge more negative rates. Some color around that would be very helpful. So that's the NII question, or maybe two questions. Apologies for that. Lastly, on the core equity tier 1 target of 12.5, it seems like you have changed the tone slightly on capital return, and you now say that given COVID, you will be targeting a significantly higher buffer versus the 12.5%. Can you put some numbers around how much of a buffer you're thinking about above the 12.5% in terms of capital return? Thank you.
Thank you very much, Stefan, for your questions. Yeah, I mean, the first question is question 1A and then 1B, I would say, and then there's a question 2 on CET1. So Tanate will take the NII and the CET1, and I will take the net interest rate charging. So on Belgium, we had announced, and that started as of July, that we will charge deposits over 250,000 euro. In the Netherlands, we announced, and that starts as of the 1st of July, that we start to charge as of 100,000 euro. And in Germany, we announced that we will start to charge clients with 50,000 euro or more. The latter part being delayed, obviously also linked to the conclusion of the High Court on changing of conditions for your clients. So for that, we will, of course, need to send letters to our clients to agree on these conditions, so that will take a bit more time. But we will continue to look at the developments, and we will continue to look where there's a need with the pressure that we have on our liability margins to charge. We can never say something to the future, but and we are doing well in terms of diversifying our income and looking at our business lines, but also we need to look at what is appropriate charging depending on the market circumstance in terms of negative interest rate, and we will keep looking at that picture.
And Stefan, first on TLTRO, I think if you look at our ability to achieve the first target, I think that gives us confidence in our franchise. And then we're coming off a relatively lower level in October, which is the start of the measuring point. And so I think we are confident of hitting the second TLTRO. And then on your second point with respect to core tier 1 guidance, we have not changed our guidance. Our guidance remain to, over the coming years, to get to that around 12.5% core tier 1 level. And we always caveated, of course, that we will take our time during the period where COVID still plays, and that guidance remains unchanged.
Understood. Thank you.
Our following question is from Mr. Kiri Vijayarajah of HSBC. Go ahead, your line is open.
Yes, good morning, everyone. A couple of questions from my side. So in terms of the various market exits you've been doing, France, Czech Republic, Austria, I'm just wondering, is that rationalization program kind of now done, or is there still some of your weaker, smaller geographies still under review? So just an update there. And then on the outlook for volume growth, specifically in the wholesale bank, looking out to the second half, you sounded quite optimistic, but could you just have a bit more colour on where you see that growth coming from? You know, how much of it is coming from outside Europe? You know, which sectors is your financing pipeline looking strong? And I guess it's kind of early days, but as government guaranteed lending mechanisms fade away in some of your geographies, I wonder if there's scope for some margin expansion in the wholesale book, or is that kind of too early to see those kind of trends? Thank you.
Thank you very much, Kiri. So on the rationalization of the markets, basically you've seen the announcement of selling Austria to Bank 99. Czech Republic, we're well on our way to transfer to Raiffeisen. And on France, we announced a strategic review. So we have not come to a conclusion as yet. So I want to be clear on that. And that strategic review will likely take until the end of the year. But if not, we will come with conclusions. But the conclusion has not been taken yet, but it is under review. I will continue to look at our business performance. That includes geographies, but also business lines. And when it comes to retail geographies, like I said before, I will look at four lenses, which is the attractiveness of the market, the ability to reach scale, the ability to get to decent profitability in the medium to long term, or the benefit that the presence in the market has for other markets, or whether that country does deliver something that can be used by other markets as well. So I will continue to look at that. That is, by the way, always the case, but also in the light of the current environment, I will continue to assess our business lines, but also to assess various businesses, even beyond geographical lines as well. When it comes to the outlook of loan growth in wholesale banking, like we said in the first quarter, there is likely some pull forward as a result of TLTRO. Now that has happened. That's also why you see, for example, the loans in financial markets being repaid. That is a significant part of it. What we do see is that Asia Pacific and the Americas are already in transition. There we see stronger pipelines. There we see more deals in our green light processes. In Europe, or a number of markets in Europe, we still see that the usage of working capital is at still a relatively low level. And so I think that when confidence in, let's say, the relinquishing of the lockdowns restores, there will be more working capital need and there will be more capital investments. So that will gradually come over time. And as per wholesale banking, you also asked about guaranteed government loans. Yeah, that there were a few particular loans in which there were government guarantees or government support for some larger clients in specific circumstances. But in general, in wholesale banking, there was not that much of guarantees in the first place on these loans. That took more place in the mid-corporate and SME space.
Okay, great. Thanks, guys.
Next question is from Julia Aurora Miotto of Morgan Stanley. Go ahead, your line is open.
Yes, hi, good morning. Thank you for taking my questions. So the first one will be on fees. ING has a target to grow 5 to 10%, but actually has nicely overshot the target so far. And with basically the levers that you highlighted still to come, actually 855 probably looks low as a running rate. So would it maybe be time to update the guidance? Is there potential to actually be above 10% over the next year or so, or any more color that you can give us on where a potential good run rate for fees is? That would be great. And then secondly, sorry to go back on loan growth, quarter to date, are you seeing any evidence of, first of all, loan demand picking up, but secondly, of deposits going down because people maybe move them to investments or, start saving less? Thank you.
Okay, thank you very much. I'm pleased that because I think that in the past our 5 to 10% was seen as overshooting. But if I translate, Julia, your question well, you're now suggesting that I'm undershooting. So I need to reflect on that question. I'm very happy with the fee growth, and there are more levers that we can continue to pull. Like I said, developing new propositions, introducing daily banking fees in markets where, by the way, we have not introduced daily banking fees at all. In some markets, our daily banking is still for free. And of course, also extending our investment products in markets where we have not done that as yet, or can benefit of of what we rolled out in Germany. Or moreover, in Germany, we're now moving from, let's say, execution only also to simple advice. And other banks have done it in the past, but as I said before, we come from a very low fee environment business, and we're gradually moving ourselves into this space as well. So we have an ambition to grow with 5 to 10% on average per annum. That's not only for this year, but that's also for 22 and it's also 23. So I would like to stick to that guidance, but as I told you, I'm quite confident about the lever that I can pull on that front. When it comes to loan growth, we do not give forward-looking guidance, but what I can tell you, what we've seen in the second quarter, And that's what we have, of course, with a business bank and consumer lending that is largely focused on Northern Europe. We actually saw contraction over the past number of quarters, and this was the first quarter again that our business banking and consumer loan book, albeit small, but grew with about 1 billion, and that is a first positive sign for that part of the market. And then you had one question, but you were linking the loan demand question to deposits and investment products. Can you repeat that question, please, Julia?
No, I was just thinking, because over the past year, deposits have been growing much more than loans versus the opposite dynamic happening before. So I was hoping that can turn.
Me too.
I was wondering if in Q3, 2 days, you are seeing any evidence of that turning.
Well, we do gradually see that again. I mean, you see, what do we see? Good growth in mortgages with 4.2 billion at a rate which is actually higher, if you look at it from a quarter and an annualized basis, higher than we've seen in the past number of years. So, healthy mortgage growth. We see in business banking and mid-corporates, and please note we're largely a Northern European bank on that front, a gradual return to growth. This is the first quarter in a couple of quarters that we grew. And in wholesale banking, we actually saw that loans contracted. That had on the one hand to do with the pull forward of TLTRO, two with companies in Europe not yet using that much working capital and capital expenditure, but also because of strong capital markets where companies can benefit from going to the bond market. Now, that will take a bit more time. Again, this will not be structural. At some point, the growth will return. But given where we currently are in Europe, it will take a bit more time than we are seeing in Asia and the Americas. I hope that answers your questions.
Our following question is from Mr. Raul Tina of JP Morgan. Go ahead, please. Your line is open.
Good morning. Thanks very much for taking my question. I'm sorry to bring you back to the risk of undershooting on fees, I'm afraid, as a first question. I just wanted to ask about the investment product fees in terms of sustainability. Just given, it's up 20% year over year. If I look at, the first half of 2019, pre-pandemic, it's up 60% over that period. And obviously there's an inflow of AUM, and there's also clearly this market volatility environment. So I just wanted to get your thoughts on how sustainable you think the investment product fees are going forward. And then the second question is actually just on capital distribution. Obviously, there's some concern about the remaining 1.7 billion. In terms of your language, you say post-September, but clearly that could mean early next year as well. I can assume that the lack of precision on timing is basically due to the fact that you're waiting for, the ECB approval process on buybacks, which is slightly longer, rather than any kind of intention on your part to delay this payout. Is my understanding correct on this? Thanks.
Thank you, Raul. I will take the question on fees, and I will leave capital distribution for Tanate. On fees, yes, if you look at the investment product fees, we indeed had good growth during Corona time. That's, by the way, also because we did not really start with that app so long before Corona. So we were just starting it up. So it is not that we had a much lower level pre-Corona and then in Corona we benefited from it. We also were gearing up to actually being able to offering that on the app. And by the way, we just launched Comfortanlage, which is the video advice product that we now put on top, and we just started with that. So if you look at the quarters, in our view, the second quarter on investment products is more structural than the first quarter. The first quarter had also to do with quite high volatility compared to what we on average do see. The flip side of it is that our assets under management grew, but also the investment accounts grew with approximately 160,000. So what we need is continued growth in assets under management. What we need is growth in investment accounts. And then, of course, there will be some volatility about the number of trades. but that is then forming a good basis. So it's the mix of those three that will help us to further grow our investment fees as well as rolling it out to other markets as well. But of course, if you look at payments, and that's the second element of it, these increases will be more structural. We increased payments package fees in the Netherlands and Belgium with 15%, and that is just there to stay. And we're looking at how we should develop our fee propositions for payment packages in other markets as well. As I told you, in some of the markets, our payment propositions are still free or nearly free. And then, of course, you do see in payment packages that's the fixed part of it. If you look at the more volatile part of it, it is transactions. And there, of course, you see due to the pandemic that international travel is quite low. In most of the markets in which we are active, those are debit card markets. And as travel returns, that will go to credit card markets. And that means that our fees on these credit cards will go up as well. Tanate, on capital, please.
Yes, Raul, thanks. I repeat our message, which is that we intend to return this 1.7 billion euros. We have constructive dialogue with the ECB, and just a reminder, the dividend ban only got lifted on the 23rd of July, right? So we have applied for that capital return, and we will do so as soon as we get the necessary approvals.
Thank you very much. That's very clear. On the fees part, can I just request perhaps some additional disclosure, perhaps some additional slides, because there's a lot going on in through all your initiatives in various different markets.
I see Mark sitting next to me sweating, so I think that he will look at it.
Thank you. Sorry, Mark.
Thank you all.
Our next question is from Ms. Anke Reingen of RBC. Go ahead, your line is open.
Good morning, and thank you very much for taking my question. First, just on net interest income, ex TLTRO, given the dynamics you are explaining, should Q2 be sort of like a stable level going forward, and the upside lever is additional volume growth? And then on your capital return, you say you reiterate the 50% payout ratio, but I just wonder on the how are you thinking about the path from your current 15% core tier 1 ratio down towards your target, even if it's 12.5, even slightly higher? Is it 50% plus special dividend, or would you consider to increase or revisit the 50% payout ratio to make this more a gradual process? Thank you very much.
Thank you, Anke. Maybe I just give you a sense of the drivers of our NII. The first is that the impact of negative interest rates on our liability replication remains there, and it will be there for some time, right? So that's one of the challenges that we face. But having said that, if you look at the actions we're taking, I think Stephen has already mentioned the strong growth in mortgages, resumption of growth in business banking and consumer lending, as well as a resurgence in terms of wholesale banking. So I think those are there. I think if you look at our origination margin, those are holding up. So I think that's nice to see. And we are taking further actions with respect to negative interest rate charging. In this quarter, in July 1st, we are charging our customers in the Netherlands who are having more than 100,000 euros with us negative rates, 250,000 euros in Belgium, and for new customers in Germany, anybody above 50,000 who becomes a client charge negative rates. So these are all the actions to kind of deal with the impact of negative rates. Then the second question that you had, we look at capital returns in two parts. What is in line with our normal and shows whether in cash or in the form of share buyback.